Devina Mehra joins us. Let's say good morning to her and welcome her on the show. Good morning, Devina. Thank you for joining us. Your background is looking very different. Looks like you're not joining from your usual space. You're not in Dubai?
No, I'm not at home, so I don't have my regular tripod and all that.
Okay,
So
thought as much. Nice to have you back. And the markets are also looking different. What markets were looking in the month of Jan versus what they looked in the month of March. The mood point, I think, has changed. Would you agree with me?
what has happened has not been unexpected. I think the last time I was on your channel, I had spoken about the risks I see in the small and micro cap space and how at some point those risks will come home to roost. The kind of spectacular return you saw in 2023 is unlikely to repeat. So that was one of it. And there was also, in general, if I go back to February, I had spoken about it that on our PMS portfolios, we have taken hedges because we saw some short-term volatility. On the other hand, on a one-year perspective, we were not really worried, which is why we didn't take a cash call. We thought a hedge was good enough because if there's an up move, you don't want to miss out on that up move either. So that was the balance we sought to achieve with the hedge. So that's pretty much how it panned out. So nothing that has happened up till now has been unexpected, at least where I'm concerned.
So what should we expect now? Now that what has happened was not unexpected, what should we expect after this so-called adjustment?
I think you will still see some volatility for at least a month or two. But as I said, I don't see a big risk of a crash. Of course, you have to choose the sectors carefully. You have to choose the market cap categories carefully. You have to choose the companies carefully. All of that remains. But having said that, it's still this is the point I have made in the past also, that if you look at the Indian markets, we had that whole decade of 2010 to 20 where the compounding was very, very low, barely above fixed deposit rates, and that created that room for the market to go up. So we are not still above the trend line as far as the mainline indices are concerned. So that's why the risk of a crash is not that high. But on the small cap side, especially many new investors don't remember what kind of crashes you can see there. So you can see that in terms of the markets, you can be down. In 2008-9, the index itself crashed almost 80%. So a lot of stocks were completely wiped out, and that small cap index level came back in 2016. You had another year and a half of a bull run in small caps, and 18 again you saw a nearly 2/3 crash. So those are the risks there which people forget when the euphoria is on. And small caps, unlike in large caps, can't even really do the stop loss kind of risk management, because when those stocks fall, there is no bottom and there are no exits. So those are the things I would still like to warn the viewers about.
Devina, what's your take on industrials now? It appears that a new wave of positive notes are coming in. Just today, there's a brokerage upgraded ABB, the 40-50% kind of a target upgrade. Stocks after this kind of a rebound from the recent lows, especially the engineering and capital goods mid-tier names are very active. You've been overweight on industrials for some time now. Are you facing challenges on valuation front, or you're happy to hold them?
So, I would like to say that the sell side, which is the brokerages, are normally behind the curve. And most people kind of discovered industrials in 2023. We have been overweight since October 2021, so 2.5 years already. And obviously, in 2021, they were coming out of 12 years of being absolutely a dog sector, compounding at 2.5%. So, that's when the room was there. We are still overweight industrials. But every quarter, the question we ask ourselves is that, is the story over? Till now, our systems have not signaled that the story is over, but I expect, as of sitting here today, I think sometime this year, maybe the story will be over. And of course, we've trimmed, we have changed stocks, and we've done all of that. But we are still overweight that sector as we speak today.
What about the underlying valuations? While we may talk about the big picture, the cycle being supportive, private sector capex which has started. If I just look at dipstick, I'm looking at the top 5 names: Thermax, ABB, maybe Siemens. All of them are trading at P multiples which are 50 to 60 times 1 year forward. Does that make them expensive, or one should ignore the underlying P multiples?
No, I don't think you should ignore Ps, which is why I said that over time there were stocks which doubled and tripled, and we either got out or we trimmed and we moved into something else. So it's not, while we've been overweight industrials, it has not been exactly the same stocks for 2.5 years. In some cases there have been, but a lot of them where the valuations ran ahead of themselves, I have not really, we've not necessarily held on to the same stock. So valuations are never irrelevant.
Devina, I wanted to understand, what's this insatiable appetite for small caps really telling you about the market? I mean, we were just noting down as to how much the recovery in the small cap index alone has been, and I'm not even getting into individual names. From the recent lows, the index has already recovered 7%.
Yes, but that's always in the nature of any of these euphoric places in markets, or for that matter, any market, whether it was crypto or anything else. So that per se, I mean, there are a lot of new investors who thought and who are maybe still thinking that this is the place to make money. And obviously, there are patches when you do make money. So, but then you have to see when it's getting into frothy territory. And in any case, see, in terms of philosophy, I always think that instead of maximizing returns, you must first manage the risk. It is, investing is a loser's game. I was looking at mutual fund data. I think it was an ET exercise itself, which where they looked at mutual fund performance and how the mutual funds schemes did in an up move and a down move. And there's a very interesting statistic that one of the schemes which was right on top, outperforming 93% of the up moves, was actually almost the bottom scheme in its category because it underperformed the down move. So when the market fell, it fell more than the market, which compensated for the fact that when the market went up, it went up more. So the schemes that ultimately came out ahead were the ones which outperformed the down moves, where the drawdowns were not as much as the falls in the market. So that's always the basic principle, that avoid the big losses, avoid a big hit to your capital, avoid losing, and then you will win. So that's the way we manage it. That's the way I would recommend your viewers also manage their portfolios.
Okay, so you do sense froth within small and mid caps, right? And would you say that the best of the rally could very well be behind us?
Yes, I mean, you will have to look at it because now the SEBI definition for the mutual funds of small and mid cap is number of stocks based. So, it's a little difficult to look at it that way. I mean, we really look at that the riskiest part of the market is below 5,000 crore market cap. But below 1,000, we don't even look at it. But between 1 to 5, also 5,000 crore market cap, we are quite cognizant of the risk. So therefore, we limit exposure and all of that. So mid caps, there are all kinds. So I mean, some of the mid caps are pretty stable companies as well. So not everything there is frothy.
Where do you see within PSU there is scope for earnings appreciation and price appreciation? Where do you see within the PSU space that opportunity is there?
See, PSU is a very diverse space. So, I mean, you can't lump banks and oil companies and capital goods companies all together. So, I mean, just because they have the same ownership pattern. So, really, you have to look at the categories. If I look at today, the PSU space where we would have a little higher exposure is PSU banks. We are overall underweight banks, but within banks, we are overweight PSU banks. But everything else you have to look at and also make sure that, sometimes there's a lot of euphoria that so-and-so company has got an order, but orders can work really both ways because usually during project execution, there are overruns, you get the money for those overruns, there are all kinds of complications. So, and now the valuations are not very, very cheap. So you will have to look at each company individually and see what's going on.
Really appreciate your time. Thank you very much for joining us. And, thank you once again, because I'm sure it must be, 8 in the morning in Dubai?
That's always the case for these morning meetings.
So we caught you
Morning
before
meetings.
the breakfast or after the breakfast?
Before.
All right. So thank you for joining us. And then after the show, please enjoy your breakfast.
Thank you.